Good afternoon, everyone. It's great to be with you today at Sibos in Toronto. Let's talk about IT modernization. It's a topic I'm really passionate about, and that's why I work at Murex. We provide capital market solutions and services to fundamentally replatform the ecosystem of 300 financial institutions in 60 countries. Over the 17 years I've worked in fintech, I've seen a lot of changes in how IT has served capital markets. And today we are at a new inflection point. IT systems are getting older and they start showing their age. They've not been designed with user centricity in mind, and they have a hard time keeping up with new requirements and new needs. At the same time, despite a 14-year high record profitability by banks reached last year, the return on equity remains weak, around 12%, far below the levels we had before 2008 and the great financial crisis. And the business margins remains weak, and the systems are getting older and older. And so for many firms, it's not economically viable anymore to keep the system as they are. They must modernize their IT landscape, and they must do it now. This is translated in terms of budget. $100 billion expected to be spent this year in 2023 globally in IT. It's a 20% increase compared to the previous year. And so for the business managers, the technologists in the room, let's review an approach that will enable us to bring the IT landscapes from today to tomorrow. We call that urbanization. If you're not familiar with the term, you probably aren't alone. So let's define it. Urbanization comes from architecture originally, coined in the 19th century by a Catalan engineer working on expanding the city of Barcelona in Spain. Now, applied to information systems, that's the definition we'll have for today. Urbanization is to organize the continuous transformation of an IS to optimize its added value, to make it more responsive and flexible towards business changes while relying on tech opportunities of the market. What does this boil down to? Creating an IT landscape that is scalable and maintainable with changing capital markets. So over the next 20 minutes or so, you learn more about urbanization. With step one, which is defining what is the IT landscape you're dealing with, so you know what problems you're facing. Step number two is about designing the target landscape, and I'll share my views on what I think is a desirable landscape. And step number three is the pathway, how to get there. So let's start first with step number one, which is defining the IT map you have. Easier said than done, because of many challenges that many firms in our industry are facing. Most of these challenges are coming from the fact that the systems are old, and they're been slow at evolving. In fact, if you look at the average age of an IT application in a bank, we're looking at 14 years. That brings us back to 2009 and the great financial crisis again. If you remember, a few of us were still using BlackBerries at the time, and I think Android was just getting started. And so when I get to meet with CTOs for the first time, they usually share their IT map with me. And most of these IT maps resemble a spaghetti plate, essentially. This is a real IT map, blurred for the occasion, from a market maker headquartered here in Toronto. Very active on fixed income, currencies, commodities trading, as well as equities and treasury markets. Has anyone ever worked for a firm whose IT landscape has hundreds of systems like this? Such an IT landscape causes 5 fundamental issues for any business. The first one is lack of interoperability. The CTO of that bank had a very clear vision. They wanted to improve the enterprise functions of the organization. Think about XVA desk. Think about credit limits. Business processes that require, among other things, great trade data synchronization. Such systems could not provide such trade data synchronization. Problem number 2, high inconsistency, resulting on the permanent need for reconciliation across systems, which is expensive. And I see that with 100% of the RFPs I receive. IT want to slash the cost of reconciliation between trading teams, risk teams, back office teams. Why is that? Because it accounts for 30 to 40% of the back office labor cost to reconcile fragmented internal systems. Let that sink in for a moment. 40% of your back office cost just for recon in 2023. For our industry, it's about $14 billion spent, 40% internally, 60% for vendors. Which brings me to total cost of ownership. TCO viability is absolutely crucial for CTOs who have to juggle between providing cutting-edge technology to business and economic viability. Now, running a business based on this IT ecosystem is extremely expensive to maintain and to evolve. Problem number 4, limited scalability. That bank could not deploy a new carbon certificate desk. A pretty big deal in Canada in particular, considering emerging ESG regulations. And finally, poor UX. Trying to create a powerful, transparent UX for all the users of the bank leveraging that IT architecture is almost delusional. That bank had to rely on 5 distinct systems for their FX exposure desk to do intraday hedging. The hedging was poorly done, it was slow, and it was prone to costly errors. So this example is a pretty good proxy actually for what I see at many institutions today. And with so many problems to deal with, I find it useful to simplify this multidimensional issue along 4 key properties. Is your IT landscape agile? What is the speed of your IT landscape? Is it integrated overall? And does it have the property of integrating well? On the y-axis, you have speed and agility. These are crucial for high frequency of deployment, low lead time for changes, and operational performance. These are 3 of the top 5 criteria that most IT systems are looking after. On the x-axis, integrated and integrating well. What does that mean exactly? Well, integrated means you have a system that is self-reconciled based on consistent data, based on unicity of data storage and calculation. Integrating well is different. An integrating system is a system that was designed to make it easy and fast for other applications around your ecosystem to integrate with each other. What does that mean for capital markets exactly? Think about the ability to provide a securities inventory firm-wide to all users, whatever application they're using. A trader in Hong Kong selling US stocks, a repo desk in London, repoing out US treasuries, or a collateral desk pledging securities, muni bonds in Toronto. All these people should be able to access in real time this inventory. That's the idea behind integrating well. As I get to meet multiple CTOs, I get a good sense for where existing landscape, existing systems are fitting on the map. Let's start with the first one, the legacy systems or old systems. They're right there at the bottom left. These are very robust systems, but they can't really change down the line if you come up with a great idea of a new product and a new service you want to release to your users. And they don't really have any APIs either. Let's move to the second type of systems, the so-called best-of-breed systems. They're right there in the middle. They're not bad, but they're not really great either. They're much better at providing incremental functionality, though. But they've not been designed, again, with the need to integrate other systems around them. That leads us to the third type of systems we most frequently see, which are the in-house application, in-house built applications. These are fast at first, often driven by tactical business requirements coming from the business. But because of that, they're not really managed as an asset for the company. They're not managed as a project, which means that they're not designed with maintenance and evolution in mind, which means that the maintenance is costly, which means that it's not done frequently. And by the time these products go into production, most of the time they're already outdated, which means that when you have new requirements, they can't be satisfied after go live. So if we take a step back, what we really want for capital markets and evolving needs of capital markets, it has to be something here on the top right corner, something that is fast, that is agile, that is integrated and integrate well in the ecosystem. It would have all the stuff we want because it will enable you to release faster and break less. That leads us to step number 2 of urbanization. Once you know what you're dealing with in terms of IT landscape, what your problems are, the step number 2 is really essentially to define where you want to go. And to do that, you have to start with UX and the business processes and make your way backwards to the technology. So your IT systems have to provide for your internal users, your sales, your operations, your finance teams, your internal developers. Your IT systems also need to support the needs of your external users, your clients, high net worth individual, corporates, hedge funds, banks, etc. Your IT systems must support the business processes of all these users, and they're very different. Credit trading processing is very different from commodities trading and processing, resulting in different design when it comes to defining the front end. Likewise, if you're looking at stock brokerage, it's a low latency activity, very different from structured data issuance, which is a high latency activity, resulting in different expectation when it comes to the design of the back end. And so I find this useful to categorize business processes along 2 categories. The ones that have a high potential of standardization, of automation, and are relatively stable over time. And those who have to adapt and evolve with changing market conditions. For the first category, what matters most is the integrated property I mentioned earlier. The reason for that is because you get all the data you need. If you look at processes like value at risk, fundamental review of the trading book, relying on centralized data removes any risk of inconsistency. Likewise, an integrated platform has all the data, it's self-reconciled. That's what I mentioned earlier. It allows you to slash the 40% reconciliation cost I was talking about. And so it comes very handy for processes like corporate actions, regulatory reporting, collateral management. Now, for the second category of business processes, what matters most is really the integrating property. Why is that? Because it allows you to develop new applications fast and make them available for your users to deploy new services and experiment with trade ideas, while having the ability to have them integrated with the rest of the ecosystem. So having the integrated and integrating landscape allows you to have unicity of data and data calculation, and to develop, test, and deploy new services without the expensive collaboration overhead you have between teams. That's what makes the IT ecosystem scalable and agile and fast. Now, one bonus you have with such an infrastructure is that applications or features initially developed for the user on the left-hand side become extremely easy to deploy for your external users, your clients. So think about services like bank as a service. One final note on this, there are a number of design elements that are not really up for discussion. They are the non-negotiables. So all the applications beyond your design choices have to rely on evergreening principles, DevOps practices, being built with cybersecurity in mind first, and obviously have the right personnel to operate these applications. All right, so we've seen what the current IT landscape is, the problems you're facing with them, what would be a desirable target. Now, let's look at the way to get there. And we ask ourselves usually two questions. The first one is, what options are out there on the market to build this integrated and integrating platform? The second question is, what options do I have to increase my return on investment while decreasing my risk? And we start with managed services. Software as a service has been revolutionized by vendors operating on the cloud. If I look at the Murex clientele, for instance, about half our clients here located in Canada moved to SaaS over the last couple of years. There are three reasons or expectations for such firms to do that. The first one is remove the burden of maintenance and infrastructure. That includes the management of third-party components obsolescence, cybersecurity threats. Number two, you obviously have access to cutting-edge technology, but most importantly, a faster time to market because it's operated by the vendor. And number three, and it's absolutely crucial, the flexibility. You still want to retain flexibility on your application and get the insurance that your customization will keep on working going forward. That's made available through services like CI/CD infrastructure as a service, where teams can leverage self-service and self-service. Now, what's very important for SaaS is that the people who are managing the features and the time to market are exactly the same people in charge of the stability, the quality, and the performance. And that's exactly what gives CTO the peace of mind, because the risk is fully transferred to the vendors. Beyond traditional SaaS, we have BPaaS, which has become much more prominent in our capital markets industry. BPaaS is all about outsourcing non-core business processes to third-party vendors in order to reduce the costs and to free up resources. I personally find them most relevant for highly complex but highly standardized processes. So think about XVA calculations, think about regulatory reporting. Now, the bonus here for the financial institutions is a pay-per-use approach and the access to a highly optimized business process. These processes are managed by vendors. They have a vested interest to optimize them as much as possible, to maximize the number of subscribers, and to do so, they hire talented people specialized in these business processes. Now, beyond managed services, there are two key trends in capital markets, system architecture, that help us build the target landscape I talked about. The first one is the decomposition of application into subsystems, breaking down complex application into modular, smaller components to increase agility, scalability, and fault isolation. Subsystems typically have a different code line and a different release life cycle, while remaining completely connected with the rest of the application, more specialized on enterprise functions. What does that mean for cap markets? Well, one example is you can design a subsystem for the agile needs or dynamic needs of a sales desk, while the rest of the enterprise functions are fully integrated with the rest of the ecosystem. The second aspect is when you look at establishing IT solutions, you have to select IT solutions that are designed with APIs first in mind in order to facilitate the integration and the integrated aspect of your landscape. Now, when you design such application, when you design such effective APIs, you really want to have an outward-looking approach to it. which means that you want to understand the business process end-to-end within the financial institutions, so that the design of the platform, the service, the technology, and the API is done accordingly. You can't really have an open bar API type of approach and try to figure out how you're going to try to use these APIs. Now, there are a number of technological breakthroughs that are redefining everybody's expectations when it comes to non-functional requirements. And the first one is cloud elasticity that has changed dramatically the way IT applications have been modernized in capital markets. Access to infrastructure scaling, rapid provisioning of resources, pay-as-you-go models. This is what provides CTOs with the flexibility to adapt to evolving market conditions. And of course, you have AI, because we can't get enough of AI these days. What are the applications of AI in capital markets? I'll just select 3 for today. The first one is around automation of manual, repetitive tasks. There are plenty of presentations this week at Sibos around AI application for reconciliation and fraud detection, for instance. The second one is, I find more interesting. It's called deep edging. That's something we studied a lot at Murex these past few years. And it's kind of fascinating. So the whole idea here is to have deep edging. It's using AI to model and predict market behaviors in a way impossible before. The depth and breadth of exploration you can have enables desks to have better data-driven decision-making when it comes to hedging large exposures. Now, the speed at which the underlying trained model is evolving solves a long-standing issue we've had in our industry. In short, traders have been using very complex pricing models for very complex derivatives. And these models were approximated by many other departments in the institution, risk, finance, and so on. Relying on a unique, fast model removes the inconsistencies that we used to have across all these people. So that's a second application. The third application is obviously for firms like Murex, software vendors. Software engineers are looking at AI essentially today to remove the blind spot humans have. And the prime application for this is essentially around development and testing. So if you consider fuzz testing, for instance, it's a technique that consists in sending random, unexpected input to a system to detect vulnerabilities and defects. This is expected to bring much more resilience to the overall IT ecosystem. So we've seen IT landscape, the desirable targets, the different options you have. I want to share what I see on the markets in terms of patterns. The first segment I have here is global banks. These are still relying heavily on in-house builds. They think their problems are so unique and specific that they can't rely on vendor packages to solve them. Or when they do, it's on very specific business processes leveraging managed services. This said, it's extremely expensive for them to run, and more they start engaging with vendors like us into urbanization approach. The second segment is multi-regional banks and large insurances. These are quite different. They're really all about replatforming the IT ecosystem, and they're going to pick and choose which vendor package or in-house build they're going to use for that purpose. More and more, they're relying on SaaS when possible, made possible by the regulator. And our role as a vendor is really to advise them on the best use of the vendor package and how to best customize the application. The third segment is regional banks and asset managers. Very different here. They're going to maximize the use of vendor packages for wall-to-wall replatforming. Most of them are trying to look at a full SaaS deployment as well to free up resources completely. So what have we seen so far? I started by saying we are at an inflection point. Aging systems can't help you keep up with a competitive landscape where margins are shrinking. You need to modernize your IT application. The urbanization approach gives you a playbook on how to do that and hopefully design an integrated and integrating platform. I want to wrap up with one use case we published with one of our clients a few months back, a swap dealer in New York. And they had an important issue. Their XVA desk was still relying on legacy in-house technology. The processes were extremely manual, and they could not keep up with the ambition of the bank to grow the business and gain market share. And so they engaged with us in exactly what I described, an urbanization journey to try to centralize that desk along other business lines into one single application. And I just want to share, the type of results you can expect by modernizing your IT. So, a couple of things. From an XVA desk perspective, they could spend all their time on value-added tasks. No more manual tasks. They looked at the risk. They looked at optimizing the risk, providing better prices to clients, which ultimately gave better market share. Incidentally, it created a good side effect, which is other desks, the sales desk, became autonomous. They could price all their trades on their own without relying on another XVA desk. From a technology perspective, fantastic. 45% gain in terms of IT support and 30% more effectiveness in terms of releasing new products to the market. I feel like it's a good example of the benefits of spending time of modernizing your technology. I leave you with one thought, though. I believe that the most underground strategic impact you can have for 2024 is not to create an ESG desk. It's not to invest in a proof of concept with CBDCs, but rather it's to rethink the way you manage your IT landscape lifecycle. It's all about making constant, long-lasting changes as opposed to doing disruptive changes. If you want to learn more about urbanization, I will be on the opposite side of the hall, booth K11. In the meantime, thank you for your attention and wish you a great Sibos.